Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Welcome to Vantage Point with True North Wealth Partners. Eric Sousa here.
And I'm Andy Smith. We appreciate you all joining us for our episode 1 of our podcast, which we're excited to finally get out to you all. We've been wanting to do it for a little while, and appreciate you guys being with us.
How was the 4th?
It was good. Yeah,
I tell you, unique times indeed.
That's right. COVID 4th of July, right?
Yeah, that's it.
Yeah, interesting times for sure. And growing the beard and face masks, all that stuff. So trying to
stay safe.
Yeah, keep everybody safe and. Crazy times and crazy markets, right?
Yes, they are.
Yeah. So what's going on?
Yeah. Well, today is July the 7th, 2020, and with that said, the markets are pretty much they're grinding back higher. A heck of we did not see the V recovery in the stock market, that's for sure. But there is a disconnect, obviously, with the stock market and the overall economy. But the good news is at least the markets are coming back. Now, do we see us having a retesting the lows of March 23rd? No, I don't think we'll go that far down again. But yes, there's going to be hiccups between now and throughout the end of the year here. We have elections, the virus, a lot of things. There's still earnings, in particularly, to overcome. And with that, markets in general, though, Andy, I track, and for those of us that know, I track spreadsheets on trading volume and things like that. So we're basically doing 5 billion trades a day, approximately, which is about 46% greater than the trade volume of last year in 2019. So basically what that means is, a lot of nervous folks out there, both retail, institutional, which is understandable during the circumstances that we're in. In regards to like the models and things of that nature, I know we've been working on that for a while now. I know you put a lot of time, models, funds. We've been, for those of you who don't know, on calls, probably on average 3 calls, webinars, calls with fund managers, economists, things of that nature, probably 3 times a day for the past few months. Hasn't been quite that often earlier on, typically when the markets are calmer, but obviously we've had to step up our research analysis a little bit, and so that's what we've been doing today. As an example, we used Hedge Eye in the morning. That's my daily one at 9 o'clock. We had then the First Trust, great partner, and then obviously Goldman Sachs was the last one I was on. So I know, Andy, you see a lot too, but interesting times with that. And
yeah, definitely. Yeah, it's been a lot of work, but it's been interesting to see how the markets have kind of played out for sure in the last few months. And of course, the big drop we intentionally got a little bit more defensive, in March there. As there's really no playbook, right, for a global pandemic, and so we just wanted to be a little bit more conservative, a little bit more defensive. And then as we hit the rebound, or I guess the more secure rebound, I would say, I think what we've seen in this V kind of recovery is kind of overblown a little bit, not really on a solid foundation at this point. So that's why we were still apprehensive to initiate the rebalance earlier, and we're being a little more cautious. So kind of waiting, on a little bit more of a drop, and then we can initiate the rebalance, right? And then. And what does that look like for clients, I guess, we think about the rebalance?
Great question. So, as far as, we've analyzed all the models. In the past, we've had 10 models. We've narrowed that down, obviously skinnied it down to 5 models. So there's 5 models that we utilize. 1 is conservative, 5 is aggressive. Model 3 is a moderate, it's our most utilized model. So of all the assets that we manage, Model 3, again, the moderate is the most utilized model that we do use, that our clients use, I should say. So with that, it's all about risk tolerance. We use Riskalyze back testing with a 95% probability over the next 6 months. So we have that ratios as far as what our model should expect to obtain within the 95% probability, i.e. there's always a black swan. That's that 5%. Bombing, terrorists, pandemic, you name it.
Yeah, we saw that. Right?
We saw that. So nobody has a crystal ball for sure, but it's pretty good. And with the models, basically we're going to be using asset classes that we haven't used in 15 years plus or so. As an example, we do see more choppiness between now and the end of the year. Obviously, we have elections that get through, the pandemic, the opening, reopening, shutdown, slow recovery, things of that nature. Earnings is the big one.
Next week, right?
Earnings starts. Great point. Next week. So it's funny. Like half the companies out there or no one's giving guidance. So it's like throwing a dart in a wall. It's like nothing's out there. So we'll see how that all comes to fruition. But with the Model 3, we're going to be well diversified. Probably 16 to 18 different asset classes, depending on which model a client is in. We're going to be using a small percentage in natural gas, so commodities. We're going to be actually using that. In addition, TIPS, Treasury Inflation Protection Securities. So right now, it's called quads. So the quads, not to get too technical, we have 4 quads that the cycles, market cycle in. Quad 1, Quad 2, Quad 3, Quad 4. Quad 1 is spring, Quad 2 is summer, Quad 3 is fall, and Quad 4 is winter. So it's just a metaphor. But we were in a deep Quad 4, that's recessionary. So with the Fed, what they did, obviously, is keep us from going into a depression. So yes, they had to do what they had to do to keep us, the economy, from going into a depression. So that's that. So we're coming out of a recession. So the recession is what we have been in for the past few months. Technically, this will probably end up being the shortest recession that the markets have seen when it's all said and done, when they look back about another few months from now. So with that, we're glad to come out of that recession, but it's going to be a grind for the next year and a half. So that's why we're using consumer staples, sort of defensive postures, mortgage-backed securities. We're going to get back into short-term high yield. So the government, anything that the government's supporting, the high yield market, the mortgage-backed securities market, it's okay to participate in that, but not crazy. But we are going to nibble at that and have a little bit of exposure to that asset class and sector. So that just gives you a flavor of that. Another thing is the Internet of Things. So we're real excited. I know, Andy, we've been chomping at the bits to get into that one as well. So that's like the cloud storage. So you have the Google, all the data house warehouse center. So it's a real estate type fund that we're going to be using, well over 3% yield. So you hear the FANGs, Facebook, Apple, Netflix, Google, Amazon, all that stuff. So you're going to have a play on that space, the tech space, but without having to own those particular individual stocks. So this is a REIT type of a fund that gives you a decent yield return on the Internet of Things, i.e. the 5G play, the poles, all the little transponders, things of that nature. So that's going to be a real good asset class and fund to utilize going forward. So that just gives our clients a little flavor of what we'll be rebalancing into. And yeah, to your point, we are looking for a pullback. It's crazy, these markets, like 3 Thursdays ago, the S&P was down around 5%. Okay, great. One day, typically the markets do pull in. When I say the markets, it is the S&P 500 is what we follow primarily, versus the NASDAQ or the Dow, because those are two extremes. But with the S&P, when it does pull in, we anticipate follow-through. So the old days would be second, third day of a follow-through, not now. So it's like buy the dip and after a one-day pullback. That's a little hard to try to time, and it is challenging, obviously. Easier to see it when things are lofty to take profits.
Sure.
But obviously it's a little bit harder to try to redeploy the assets in cash. So we will be doing that. Anticipate there will be earnings, like you mentioned, start next week. So there'll be a lot of misses, a lot of companies that will be hitting as well. But again, with not a lot of forward guidance, and GDP, gross domestic product, will be negative for the year. So on one of the calls, Goldman Sachs today, I think GDP was coming in for this year negative. Their latest revision was minus 4.6% is their call. So plenty of fund managers, institutions, firms that we use and track, from NDR, Ned Davis, Dave Rosenberg, send them in. There's great tools that we use. But okay, so minus 4.6. But I think relative last year, I think it was about mid twos or so, upper twos as far as GDP. So, positive to negative, not good. But looking forward and going out, GDP for 2021, they're again saying roughly about 5.8%, roughly for 2021. And then unemployment, which is another topic, is big. Unemployment rate, that you got close to 18% or so, down to 13-14% range. With that said, so for this year, unemployment, they hope by the end of 2021 to get it down to close to 7%. So if you stop and think, 7% unemployment rate is what a firm is looking to hope that we'll be at. Well, in February of this year, we're actually at 3.5%. So we're going to be double the unemployment rate still at the end of next year, of 2021. And then from there going thereafter, 2022 would be down closer to the 6% range, and then roughly 2023, 5.5. So it's going to be the grind, slow grind from the unemployment part of it all.
Yeah. Amazing what 7 months can do, right?
I know.
And two, you keep in mind a lot of the government programs are going to start dropping off, right? We have the added unemployment benefit drops off at the end of July.
Yes.
And we've got, some of the mortgage forbearance, some of those programs are going to be slowly falling off, where it kind of leaves the consumer a little bit more exposed, or potentially, depending on what the Fed does, right? So the Fed can always come back in and extend some of those programs. And as since it is an election year, it wouldn't surprise us, I guess, if we see some more activity from the Fed. But yeah, definitely crazy times this year. I think it'd be fun sometime maybe to do an episode where we can kind of maybe show, I don't know how it would look, but to show kind of the clients behind the curtain a little bit, and just how much we really do rely, on our research team and the partners that we have and the feedback we get, which is really, it's phenomenal for sure. So
as you know, we're geeks about this stuff, so I eat it up, obviously. I enjoy it and track it all, so the best we can. So, no, I hear you. Just moving on to another topic, I guess, it'd be the virus. So, just some interesting facts that came out today from the webinar I was on as well. The infection rate. So it's pretty much coming from those ages 0 to age 64. And that's basically 81% of the infection rate is from that age group. So I thought that was, interesting. And then, however, though, the fatality rate, that's a 79% fatality rate, is coming from greater than age 65. So fatalities are obviously coming from the older side of the folks, greater than 65, versus the infection rate. So, we talked about this for the past few months. We both didn't know anybody who had the virus until about 3 weeks ago. That's right. My aunt. So my poor aunt, she's 87, and she picked it up. She's at a nursing home, go figure. But the physical therapist brought it. She was exposed and gave it to my aunt's roommate. And then so the aunt's roommate got it, and then obviously my aunt picked it up from the roommate. So then she moved from the nursing home to the hospital, was treated. Thank God she fought it, recovered. So she has so many ailments. We really were nervous and scared about that. But she's now back in the nursing home. So back to, So that's an interesting thing. And one thing on nursing homes, for those of you, the hospital system does not want to keep COVID patients. So they are pushing them out. They want to, because they're not a nursing home, is what they are telling my aunt. So these nursing homes are adapting to have COVID units. So the nursing home where she's at now, which is nearby here in northwest part of Columbus, is basically it's over 20 folks who are COVID patients, but they're doubling up as a unit. So just a little food for thought how the nursing homes are adapting and changing their way of doing their business model as well. So,
sure. Yeah, and you see the hospitals wanting, for someone who's recovered too, right? They want to make room for someone who,
understandable,
who can maybe use it, or needs the help more, I guess. But yeah, Yeah, and I know too. One of our attorney friend, or Matt Gibson, one of our partners. He's had I talked to him the other day, and he's had some clients who passed away from it. So it's like, sort of starts to kind of work to where has more of a personal impact. Hopefully, everyone's staying safe, and we'll get through this for sure.
We will. Yeah, but then with the states, obviously there are 6 states that are reverting in their reopening status. So those are California, Arizona, Colorado, Texas, Florida, and Michigan. So those 6 states are like, hey, we better slow down this process. So they're as far as the reopening, and then 13 states actually paused their reopening status. So with this flare-up, spike up, that affects the economy, i.e. GDP, i.e. people coming back to work. We haven't even really gotten into the damage that's being done with the commercial real estate, office buildings. So, I'm very familiar with J.P. Morgan. They're not renewing their lease in Cleveland, their downtown office. So that came out across the wires among here in Greater Columbus. There's other things. A lot of people, they want to keep working from home. Nationwide Insurance, another local company here as well, same thing.
That's right.
So all that's been publicized as work from home, et cetera. So it's going to be a slow, get back to economic boom times, I should say. So we talked about the virus, GDP, markets, models, sort of summarizing a few things there for you. And there's a lot going on, and we do appreciate everything that our clients, and we're appreciative of
absolutely
what we have, our health and family, and we'll do our best and continue to do our best for you and all of our clients.
That's right. Yep. And we are, we are slowly kind of, I guess, opening back up as an office, sort of, where we've got the masks, we've got, hand sanitizer. We obviously follow the guidelines that the states put out for us.
Gloves too.
That's right. Gloves. Yeah. Aaron Moore comes in, he's got gloves on. It's kind of funny, but but we do, so we can accommodate meetings slowly here. And then also we're available over the phone. Even, I know Zoom's popular. It's still hard for me a little bit to do some of that, but we've had some meetings over Zoom, but we just want to make sure that we are available at any time, right, to talk to our clients. And, if there's any questions or concerns, we can do that. Obviously digging into the retirement planning component as well. And the potential impact, that everything's having on those as well. So.
Well, good. Well, like Andy mentioned earlier, this is just our inaugural one, so we're going to be doing more of these on a monthly basis, and we'll have our partners, special topics. So as things evolve, timely, tax planning wise, Medicare specialists, property casualty, estate planning. So we'll bring in those appropriate partners, and we're excited to do that. So we want this to be timely, but useful information for you, our clients, and just another way to communicate with you. So we do appreciate that. So I think maybe we'll wrap it up for this one, and you can reach us. Obviously, these episodes via our website is probably the best way. It can be mytruenorthwp.com. Again, mytruenorthwp.com, or our phone number direct is 614-929-2715. Again, 929-2715. We do want to throw out special thanks to our producer, Nathan. So we appreciate you producing these episodes for us and on a monthly basis going forward. And thanks for joining us today. Stay safe, well, and we'll see you next time.
See you, everybody.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.